Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. This is a really special episode. It's episode 99. Sonu and I were joined by Dr. David Kelly over at JP Morgan. He's one of the true titans in our industry. So many cool stories and examples of how to really use, charts and tables and data to not only tell a story, but to actually be right. We think you're going to love this episode 99. Just so everybody knows, we're actually going to take next week off, the week of Labor Day, holidays and everything. But we're also getting ready for Excel, our big conference down in Florida, which is the following week, which stay tuned. We're doing episode 100 live from the main stage down there in Orlando, the House of the Mouse, with none other than Tom Lee of Fundstrat. And we're actually going to live stream that. So more details to come. But without further ado, here's episode 99 with Dr. David Kelly. Enjoy. And here is episode 99 of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, we are so excited to be joined by Dr. David Kelly. Dr. Kelly, it's episode 99. Have you ever listened to one of these? I mean, probably not. That's okay. I mean, it took us forever to have you on. I guess you should be mad at us for that, right?
Well, yeah, but we all live busy lives, and markets have not been quiet either.
No, they have not. Go ahead, Sonu.
It's so great to have you on. I mean, I've been listening to, so just so that the audience knows as well, I've been listening to Dr. Kelly for over a decade now with his calls, and I think there's probably, and I say this very honestly, hopefully, that I don't think there's anyone better than distilling everything that happens, markets, the economy, connecting it together, and then policy as well, where you have monetary policy from the Fed and even fiscal policy for that matter. So it's an honor to have you on, Dr. Kelly.
Oh, very good. Very glad to be here.
And so this is, again, episode 99. We're talking about the economy with Dr. David Kelly. So, Dr. Kelly, I guess give your official title. We like official titles around here. And then, the easiest way you can, what do you do all day? I mean, how do you help financial advisors? How do you help investors? And how do you help the clients over at JP Morgan?
Well, I'm a Chief Global Strategist for JP Morgan Asset Management. I run a team of 30 strategists and analysts around the world who cover the global economy and markets and provide advice to financial advisors, but also to a lot of institutional investors, some individual investors. And really what we try and do is understand the environment and explain it as clearly as possible. I think the thing that we focus on most is not just trying to develop insights as to what's really going on and how the economy is evolving and how markets are evolving. And all that is fascinating. But how do you express this in a way that is as simple and clear and vivid as possible? Because I think that's what's missing on Wall Street. I think a lot of this just seems too black boxy to the average investor. And there's no reason for it. Most of finance is just common sense. But we really focus a lot on trying to make the story clear.
So I think, where a lot of us probably started hearing your name and seeing you out there is the Guide to the Markets. And I just saw the Guide to the Markets turned 20, I believe, this year. And I loved you did a quarterly video, I guess almost this point, maybe 2 months ago. I watched that. And you talked about how you create all these different charts, but you said, we're just going to focus on 11 of them. And I think that's so powerful because you talk through I do the same thing. Sonu does the same thing. We talk through pictures a lot of times because people can learn through pictures. Talk to me about the evolution, if you will, about the guide to the markets, because everybody has used a chart from there or borrowed an idea from there. It's like the Bible, so to speak, when it comes to creating charts to tell stories.
Well, I actually love the use of the word evolution because that's exactly what it's been. It started out 20 years ago with a deck of 30 slides that my predecessor in this job used to make speeches. But every quarter we look at it and we get a lot of feedback internally and externally, and we look at what's going on and we say, well, what's the story we want to tell? And we would try and figure out, we'd think a lot about colors and about how do you annotate this chart and what's the scale and how, a lot of little nuances to it, but how can we tell our story most clearly? And then we simply put factual titles on it. So we don't try and express insights in the charts themselves, because we really believe that this is an interactive process. And so a lot of people look at the guide to the markets and say, well, that's fine, but why don't you say anything about what the Fed's going to do next? And the answer is, well, you got to call in or listen to ourselves or to our client advisors, but we need to have a conversation with you about what we think these data are telling us about what happens next. And we find that interaction, that human interaction in terms of thinking about it and talking about it really helps develop better insights. But it's very much been an evolutionary process. Over the years, every quarter we have a meeting or a series of meetings last a week in which we look at essentially the whole guide. We add a few charts, we take out a few charts, we make little tweaks here and there to make sure the story evolves. And it's a lot of trial and error over 20 years.
No, that's great. It's like the gold standard, to Ryan's point about, chart making in this business and telling stories of charts too. But speaking of stories, you all came up with, I love this, big 2024, 2024. That was your, I think, safe to say, story for 2024. Talk about that.
Yeah, so we realized as I was putting together my forecast for this year that I could actually tell the forecast for 2024 using 2024. We thought as we went into it that we'd have about 2% real GDP growth. We would avoid a recession, so zero recessions. We thought that inflation was on a track to head towards 2% before the end of the year. And we thought that we would average about 4% unemployment, so 2024. And, now as we enter the fall of this year, as we're going into the fall, it actually still looks like a pretty good forecast. I think we will see about 2% economic growth. I do think we're going to avoid a recession. Inflation's been a little slower coming down, but on one of the measures, and perhaps the most important one, the Federal Reserve's focus, which is the personal consumption deflator, I think there's a chance we will hit 2.0% in September on a year-over-year basis. And the unemployment rate's a touch above 4%. That's a little higher than we thought, but it's still close enough. So overall, that's what we've seen. And I don't know what I'm going to do with 2025, because I don't want to have a forecast of 2025. I think the unemployment rate should, and I hope it will, stay below 5%.
Maybe it'll be 5 rate cuts or something, but who knows? But
well, maybe, yes.
It's an idea for you. But
so
go ahead.
I want to jump in. I mean, so we'll dive into all four of those things, obviously, as we talk about the macro backdrop. I want to definitely get your take on the Fed and Jackson Hole last week. But this podcast sometimes a little playful, but this was all over social media. And I hope you had a chance to see this yesterday and this morning, Dr. Kelly, because everyone's talking about it. The Dallas Fed survey came out and said that one person in here, in the food processing part, said they're seeing modest growth in sausage dinners. And they said that means a recession is coming because people are buying sausage, which is cheaper and tastier. And I'll just say this. My daughter is a cheerleader in high school, okay? Last Friday, went to her very first game. Susanna did a great job cheering. Her team was down 21-0. They came back to 31-all, lost right at the end, 34-31. But what I'm getting at, I had a bratwurst. It's a high school football game. It was excellent. So I don't know. I'm not so sure. This is kind of playful, but maybe not. Where are some cracks in the economy, and has the sausage indicator? Have you ever heard of that? I never heard that till yesterday. What's your take?
Well, I'm not sure it's a gold standard in terms of indicators here, but
you're not going to add that to the guide to the markets. You're saying
you're making me pretty hungry for some good brats here and beer. That sounds pretty good.
Yeah.
So there is something going on, but it's always the economy is a living organism, and there's so many aspects, of so many dimensions to it. So one of the things that's going on is we have seen increased inequality, and this has been going on for a very long time. And it actually got worse over the course of the pandemic and the recovery from the pandemic. So the top 10% of households in America are doing very well. They've got a record high level of wealth, and that's gone up tremendously in the last year and a half. They're doing fine. They're sitting in houses which are worth more than they ever thought they'd be worth. Their incomes are going up. It's all looking pretty good. But if you look at the bottom 60, 70% of the economy, they are getting somewhat squeezed. Wage growth has slowed down. Now, I want to be clear. Wage growth at 3.6% year over year is still higher than inflation. So the people who are working, at the bottom of the stack, they're still gradually getting ahead, but it's slow moving. Meanwhile, in 2022, in 2021, people had government aid, and they sort of spent that down in 2021 and 2022. Then they borrowed a lot of money. So we saw a surge in credit card debt in 22 and 23 as people tried to maintain a standard of living. And now, okay, they've maxed out the credit cards. The government aid is is spent a long time ago. So a lot of people are sort of facing reality. You know what? We are actually spending beyond our means. We're going to have to cut back a little bit. And I think that is going on with lower and middle income households. That is squeezing the demand for food and squeezing the demand for clothing. And that is what you see. You see people trading down in terms of food and clothing. And that's a sign that there's some squeeze going on there. But overall, the economy overall, that is not enough to sink the economy. This economy does not count by heads. It counts in dollars. And the actions of the top 25% in terms of income are actually much more important than the actions of everybody else in terms of what drives the economy. So I still think the economy is moving forward, but one of the aspects of the economy is that people are getting squeezed at the bottom and the middle because they just can't maintain the standard of living to which they've become accustomed over the pandemic.
Okay.
To that, and I mean, thinking of again, the aggregate economy and, the labor market's role in promoting in income growth and all of that, which is employment growth, wage growth, and hours worked. Where do you stand on what's your take on what the employment situation is right now, what the labor market is doing? The unemployment rate has obviously increased to about 4.3%. We just saw a big revision in payrolls. I mean, granted, that was through the 12 months from April 2023 to March 2024. But I'm curious of your take.
Yeah, so overall, if you go back 2 or 3 years ago, we had every reason to expect that payroll employment growth would slow down dramatically, down to something below 100,000 job gains per month. And the reason we could see this, or the reason we expected this, was because the growth of the working age population, the population aged 18 to 64, particularly the native-born population aged 18 to 64, had essentially stalled out. With the baby boomers are retiring in large numbers. There just wasn't enough growth in the labor force. So we're already at below 4% unemployment. So we thought, we were going to see very slow payroll growth. Now, the government then reported for the last, year and a half or 2 years, much stronger payroll numbers than our models were telling us should be occurring. What happened when they revised the payroll numbers down is they said, well, we took a look at unemployment insurance data from the states for March of 2024, and it did tell us that there were fewer people working than were in our payroll employment report. So it did look like they were overestimating, and they go through this benchmark revision every year. And so they took it down by 818,000, and that's a big drop. It meant that the job growth between March of 23 and March of 24 was 68,000 per month lower than they had originally reported. And that's probably extended into here. So now I think we are now looking at an economy that's producing about 100,000 jobs per month. I think that's what's going on. But having said that, I do think that some of the government data may actually be missing some of the surge in immigration that we've seen. We have seen an enormous surge in immigration at the border. We've seen an enormous surge in people who've got authorization to work by virtue of the fact that they are waiting an asylum hearing. I think they are filtering into the employment numbers, but maybe not being caught by the government data. So there's a lot of noise about the government data. And the final thing I'd say is there's something called the SAM rule. It was invented a few years ago, and it was just an observation that when the unemployment rate goes up in a shorter period of time by more than 0.5%, that is often a sign that you're headed for recession. But I think something different happened this time. Because you go back to March of 2022, there were 12 million job openings. We'd never seen anything like it. If you could fog a mirror and prove you were alive, you could get hired. And that's basically what was going on. And what I think happened was a lot of people got hired who should never have a job in today's economy. And I still encounter them in many cases. But if people get hired who really shouldn't be working, eventually they get laid off. And so what we're seeing is a gradual increase in long-term unemployment and people who really are having a hard time getting a job because they're just not suited for today's labor market. That's pushed up the unemployment rate a bit. But as Jay Powell pointed out last week, it's not because of a surge in layoffs. What's really happened is we've sort of seen an increase in labor supply. We've seen a normalization of the economy. It's more, I think, microeconomics and macroeconomics. So I still think we're looking at a slow-growing labor market. I think we're talking about a slowdown, not a stall. But obviously, these are interesting times. We're watching this very closely.
So we have had Claudia Sam on this podcast before, and that's right. I mean, she's been out there talking about just that the labor market's been growing, and it's not so much layoff. You look at layoffs. I mean, layoffs have not been increasing, relative to what they've been doing lately. So until you start seeing layoffs, you think, well, I guess the labor market is okay. But you mentioned Jay Powell. I'd like to dive in a little bit more. Last week, obviously, was the Jackson Hole Symposium on Friday. He made some comments. You kind of touched on. I want your kind of big picture take on what Powell had to say. And I guess the bottom line is the market loved it because we saw 90% of the stocks on the NYSE higher. We saw 90% of the volume at the NYSE higher. We call that a 90-90 day. I did data on that. I found 28 examples of a 90-90 day going back to 1980 using data from our friends at Ned Davis Research. A year later, S&P's up 89% on average, about 14% on average. I know, Dr. Kelly, you can't really talk about things like returns and things like that, but those are the data that we just saw. So that was a good reaction. It probably means we're in a bull market. We've been bullish here at the Carson Group saying, we're going to avoid a recession. It's still a bull market. We don't see any major changes to that, especially with the reaction Friday. But talk to us about Jackson Hole.
Yeah, so the most important thing in Jackson Hole was that it gave a platform for Jay Powell to update people on where Fed policy is, and he did that, and he did it very succinctly. He said the time has come to reduce monetary restraint and to cut rates. And so that is a clear signal that we will get a cut in the federal funds rate in September. It's not quite as clear as to whether that cut will be 25 basis points or 50 basis points. I think the Federal Reserve wants to do 25 basis points. I think they want to bring rates down gradually. I think they should. There is a danger they could get sort of bullied or hurried into something faster. When he talked about the economy, I think he did note exactly what we just talked about, that the unemployment rate's gone up. He doesn't want the unemployment rate going up any further, but he thinks it's mostly about labor supply rather than layoffs. He didn't sound too concerned. And I think he's right in that. But there is something very important that I think the Fed's sort of missing here. The Fed believes that monetary policy is much more powerful in stimulating the economy and slowing the economy down than is in fact the case. He actually took credit for slowing inflation down by reducing aggregate demand. Yet if you actually look at the data in the year that ended in the second quarter, GDP is up 3.1%. There is no evidence that the Federal Reserve actually slowed down aggregate demand. And since that is the only way they could have cut inflation, they didn't actually cut inflation. Now, inflation came down. It always was going to. What goes up comes down. It's Newton's law of inflation. It was going to come down. But it wasn't because of the Federal Reserve. Now what the Federal Reserve says is, okay, the economy is slowing down. And by the way, if we get into any trouble, we've got ample space to cut interest rates. Well, that's great. But if they cut interest rates by a lot quickly, it's going to scare everybody. The most important thing your listeners can hear about monetary policy is there is a J-curve effect here. Cutting interest rates actually hurts the economy before it helps the economy. And that's what's so dangerous about the Fed doing a hurry-up offense here. If you cut interest rates, you're cutting the income for the people, the $6 trillion sitting in money market funds. You're also telling people the Fed's scared. What are they so worried about? Why are they cutting 50 basis points? Maybe I should hold off on hiring people or building a factory or expanding my business or buying a new car or buying a new house. Oh, and also, the Fed just cut interest rates 50 basis points. You think they're done? Absolutely not. So if they're not done, should I borrow money today or should I wait a while? I think I'll wait a while, right? And so it actually caused people to delay. Now, eventually when rates hit rock bottom, then there is some stimulus to the economy from the fact that the price of money is so cheap. But in the short term, it doesn't help the economy. And that's why I hope the Federal Reserve cuts 25 basis points. I think that's where they are right now. But we'll have to see the employment report. I mean, if we get a weak employment report for August, they might feel bullied or harassed into cutting by 50 basis points. And I know the market might celebrate that in the short run, but they better not, because that is the easiest way to get yourself into real economic trouble.
To that point about, like, the Fed says they're data dependent, is there some danger in being too data dependent or data point dependent? Like, the payroll report, unemployment rate, say, went from 4.3 to 4.4%. Now we have to cut rates by 50 basis points, to your point about being bullied into these things by the markets or individual data points.
Yeah, absolutely. I mean, there is basically a contradiction, isn't there, here? I mean, the Fed always says that monetary policy operates with very long and variable lags, yet we're going to adjust monetary policy based on short-term data. Well, you can't have it both ways. You can't be tactically moving monetary policy based on the latest numbers out if you actually think the effects of your actions aren't going to be felt for a year or 2 years down the road. I don't really agree with how they see it, but what they should say is we are model dependent. I guess that's harder. It doesn't sound as easy for the public to understand. But what they should say is, look, we've got a view on the economy, and each data point affects how we view the economy, the evolution of the economy over time. And if we look down the road and see the economy is going to be unduly weak 12 months, 18 months down the road, then maybe we'll adjust policy. But but for the most part, I think they should just knock it off. I think they should just gradually move the federal funds rate back to a neutral level, which I'm going to call about 3.5% to 4%, and be done with it. The Federal Reserve is very good at dealing with financial crises. They're lousy at speeding up the economy when they want to, or slowing down the economy when they want to, and they shouldn't work on it.
So again, this is episode 99 of Carson's Facts versus Feelings, talking about the economy with Dr. David Kelly. So Dr. Kelly, you're in New York. Am I correct? Is that where you're based right now?
Yeah, absolutely.
So where did you grow up and which sports teams do you like?
Well, I grew up in Dublin, Ireland.
Yep.
And so then I was very interested in rugby and soccer, which of course Americans aren't very interested in. Yeah. I lived both in New York and in Boston. So for many years, and when my children were growing up, we were New England Patriot fans, and that was a very glorious 20 years. Unfortunately, that's all behind us now. But that's kind of what
So I'm a Bengal fan. We do play each other the first week of the year, so we'll see. First week
how
of
it goes.
We'll see. But you mentioned I thought you were a Patriots fan. That's where I was going with this. What's your idea there? Because you just mentioned how the Fed's taking credit. Did Belichick take too much credit for having Brady, or what did New England? Obviously, greatest quarterback ever. Any coach is going to look good. Where do you side on that one?
Yeah, no, I think that's right. I think it was more Brady than Belichick.
I think so.
Because I mean, I think, let me put it this way. I think Belichick is a very good tactician, and I think he had some very good tacticians on his staff, and I think Robert Kraft built a great organization. You couldn't have won that many times over 20 years without it. Right. But in the end, in quarterbacking, the key is 2 minutes to go. Can you find a way to win the game you're going to lose, or the other way around? And there's nobody in the world who is more competitive than Tom Brady, and who literally subconsciously upped his game more in the last 2 minutes than Tom Brady.
No, in any case, it's a good problem to have. Good coach versus
coach. Yeah, exactly.
I'm in Chicago, and I won't bring up the Bears, but
let me ask. It's amazing. We've got like 10 minutes to go. We could do this all day. I did see the Kelsey brothers just signed $100 million contract for their podcast. So Sonu, we're doing something wrong. We're not getting off. Dr. Kelly, want to do a podcast with us all the time? I guess there's a lot of money in this industry. But you mentioned Tom Brady, and I'm thinking productivity. He was obviously very productive. Didn't always have the best wide receivers, but got the job done. In our country, like the way I just did this little spin job here. In our country, we have seen a surge in productivity. It's something Sonu was talking about for a while, that a higher productivity could be kind of that magic elixir for our economy. Where do you stand on the higher productivity we've seen lately? Will it last longer? Is it just kind of a one-time shot? How do you see productivity?
Well, first of all, I think it has been good over the last 5 years. You have to transition across the pandemic, but it's been about 9% growth in 5 years. So it's coming close to 2% per year, and I think it'll look even healthier once you put in the payroll job revision that we were talking about. Yeah. So overall, it's been very good. I think that AI is helping somewhat. I think technology of various kinds are helping. But the other thing is that a very tight labor market really does help. There's nothing like not having enough employees to make the existing employees more productive, because you're trying to figure out, well, how on earth will we get the job done? And then you find a way of getting the job done. I mean, to paraphrase Janis Joplin, productivity is just another word for having no one left to hire. If you've got no one left to hire, you've got to find a way of making the people you got more productive. And we have succeeded in doing that. American business has been doing a very good job at that.
Connecting that to something you said about like the neutral rate, 3.5%. Now going back to the 2010s, I think the Fed thought the neutral rate would be maybe 1.5%, 2%, maybe something around there. And I think, when they raised rates in 2018, it felt like the economy couldn't take it, or they had to pull it back. But now it seems like we're in a different regime. And to your point, like the neutral rate, they could drop it to 3.5%. It doesn't seem like, condition on no recession, they don't have to go to like 2% or 1.5% or anything like that. What do you think has changed?
I don't actually believe the neutral rate exists for the economy. I think it's one of those mythical beasts like unicorns and the Holy Grail. It's not there. It doesn't exist. And the reason I say that is because if you look at all the way through the last decade, the Federal Reserve was trying to stimulate the economy with easy monetary policy. It didn't work. And then for the last 2 years, they've been trying to slow the economy down with tight monetary policy. It didn't work either. I mean, the economy is slowing down, but it's not because of what the Fed did. So the way I think about it is the economy. I mean, you can think of an image of a boat in a very rough river, going down the rapids, a big unwieldy boat. And interest rates are like a tiny little paddle. And so you're paddling hard on the left and paddling hard on the right, and you're not moving the boat. The river is moving the boat. And that's the US economy. Now, and honestly, I don't think that I think that the net effect of short-term interest rates in the economy is so small net and so unpredictable in terms of how it feeds through over time that it effectively doesn't work at all. So what I think is really moving what the Federal Reserve needs to think about is what's the neutral rate for financial markets? What is a reasonable rate of return on cash investments over and above inflation? What's a reasonable rate of return on long-term investments over cash? They ought to try to achieve that because the interest rates are the most important price in the economy. You set those right, the economy will start doing the right things. You keep them way too low for too long, you're encouraging bubbles and meme stocks and Bitcoin and all sorts of nonsense. When the carrying cost of crazy is zero, people go crazy. And you don't want to do that. So you want to get back to but you equally don't want to have it too high and kill a lot of businesses unnecessarily. So you bring rates back down to I would say 3.5% to 4% is about neutral for financial markets. You leave it there and you don't try to manipulate the economy.
I love that's a bumper sticker for you. If the carrying cost is crazy, then you go crazy. But then, so the other side, I know we're in an election year. Whatever happens in the election year, next year seems to be a fairly big year for policy, especially tax policy, because a lot of the TCG had the Trump tax cuts from 2017 expired on the individual side. I was reading this morning that it seems like if they renew all the tax cuts, renew everything, that's $4.6 trillion, somewhere between $4 to $5 trillion added to the deficit over the next 10 years. I'm curious what your thoughts are. What do you think will happen next year? I'm conditioned on a lot of uncertainty there. And what do you think should happen?
Okay, so I think that, first of all, let's look at the election briefly. Right now, the polls are very close. And what that suggests to me is we'll get a tight result. We could well end up with divided government with one party controlling the Senate, one party and another party controlling the White House. That could easily happen. Or one party control the Senate and the White House, but not control the House. I think that's the most probable outcome. Second most probable outcome is a sweep, but a narrow sweep on both sides, where you still only got a 1-seat majority in the Senate or 2 or 3-seat majority in the House. In those scenarios, you're not going to see dramatic change in fiscal policy either way, because it only takes 1 or 2 people to object, and it doesn't happen. But having said that, the trend in fiscal policy is one of higher debt. So the debt to GDP ratio right now, the debt in the hands of the public is 99% of GDP. And if we don't extend all of the tax cuts, or if we don't extend any of the expiring tax cuts, we'll end up at about 123% of GDP in 2034. And if we do extend them all, we'll end up at about 133% of GDP in 2024. Either way, we're going in the wrong direction. But I think that's what's probably going to happen is most of them will be extended. I don't expect much more fiscal stimulus than that, because I think whoever has the ability to veto the actions of the administration will probably do that. But I think most will get extended, and we're going in the wrong direction. And I think there's, with a lot of problems in America, we just need to be honest with the American people about what needs to be done. And so, if we're all going to live longer, and we should, I think we need to reform healthcare to help us live longer. But if we're going to live longer, we need to work longer. I think we need to figure out ways of increasing the group of people who are in the actually working and paying taxes, and then try to rein in the growth in the cost of medical care, and then also be honest about taxes. I mean, there are things like I never liked the idea of higher taxes, but for example, the estate tax exemptions are just enormous right now. There are areas that you could try to adjust tax policy to try and offset some of the extremes of inequality in the country. There are things you should do. But I'm not optimistic that we will. I think that politicians get elected by selling simple answers and easy answers to the public, and the public is just not accustomed to being asked to do anything tough, and that leads to bad outcomes.
No, well said there. Sonu, we've probably got time for maybe one question from me and one question from you. It's amazing how fast this has gone. I do have a quick question, and maybe my real question. Obviously, I've always wondered this. From Ireland, is Guinness as popular over there? Because when I hear Guinness, I think, oh, it's everywhere over in Ireland. But is Guinness that popular in Ireland?
It's reasonably popular, and I will say that draft Guinness tastes an awful lot better than anything that comes out of a bottle or a can.
Yep.
Having said that, it was one of the reasons I had to emigrate, because I never did quite acquire a taste for Guinness. It's very black and it's very thick, and
Yes.
not quite my drink.
Understood.
I am a fan, I have to admit. So
Yeah, I enjoy them. But okay, here's my real question. I love to ask this one. If you were talking to someone, let's say a college student who was looking to get into the financial services industry, obviously, I believe, at least according to the bio, I saw you've been in it for 34 years, right? So thank you for all this cool, amazing things you've done for over 3 decades. What's some advice you'd give somebody who's looking to get into this industry?
Well, the first thing is, welcome aboard. I think I think that finance gets a bad rap. People, when you say finance, people think of the Wolf of Wall Street and think of people who are, scurrilous in terms of their attitudes. The nicest people I know are in the finance industry. I think they're the most ethical people. We do a lot of compliance to make sure we cross every T and dot every I. But there are a lot of great people. I love running the team I get to run, and work with the people I work with every day. So there are a lot of great people in finance. I think it's a great industry. The piece of advice I would give is learn how to communicate, particularly both in writing and speaking, but particularly in writing. Just learn how to write. Read stuff. Don't just text. Don't put your cell phone in a jug of water. Pick out books. Figure out how to write, how to communicate, because the big vacuum that we've been able to take advantage of for years in the business is that there's so many people who cannot communicate in finance. They know exactly how to run portfolios, get a few extra basis points here or basis points there. They can uncover alpha, but they cannot explain it to investors. Wow. And the biggest word in finance is the word trust. And you cannot build a level of intellectual trust unless you can explain what you're doing to the average person. So being able to understand, get insights, but also communicate those insights in terms of what you write, in the graphs and pictures and charts you use, and in terms of how you speak. Those are tremendous gifts, and they'll take you a long way in any profession, but particularly in finance.
No, that was awesome. I agree wholeheartedly with everything you just said. That was amazing. Sonu, it's probably our last question, so make it a good one.
No, I actually, on that, I feel like you answered what I'm going to ask, but I'll ask it anyway. Like, you obviously talk to a lot of financial advisors. Maybe talk to them as well. There's always never a single best thing, but what would be the single best thing they can do to help clients, especially when there's a lot of uncertainty? There always is in some form or the other, but sometimes it feels like there's more uncertainty now than there was in the past. But what's the best thing they can do to help clients, stick to their financial plans and investments?
Yeah, I think to tell them, again, a lot of it's just sort of turn off the media, turn off the social media. Don't worry so much about the country. Don't worry so much about the American economy. The American economy is a powerful machine which is produced year after year for decades and decades and decades. We have a country of 335 million people who work too hard, who spend too much, who want to get ahead. It'll generally be okay. It's just under no obligation to look after you as an investor. And the risks you can see, and the ones we talk about all the time. But there are other risks. People in portfolios, they've allowed the portfolios to sit there. They're way overweight large cap US growth stocks right now. They've got no international exposure at all. They probably don't have enough fixed income in a portfolio. They don't have much exposure to alternatives. Make sure you're actually diversified. Make sure you're in the right place for you. Make sure that you can get there. You have a plan to get there without writing too many big checks to Uncle Sam. So I think the best advice is to try to get people to stop worrying about the economy and the big macro stuff and all the things they hear, the scary stuff they hear, and start concentrating on what a balanced plan for them as investors should be. And if you can get people to do that, to calm down about the world and concentrate on where they are, I think that's the best service you can do people.
I love that. That could probably serve all of us really well.
Yeah,
I love that point about diversification too, and making sure you're still on track with respect to diversification. I feel like that's the first lesson everyone learns, but it's almost the first lesson everyone forgets too.
Yep.
Well, we've done 99 of these, and I have to say this might be our best one ever. So, Dr. Kelly, thank you so much for joining Sonu and myself and the Carson Group. Obviously, we're big fans, huge fans of you, and huge fans of JP Morgan. So, where can people? What be final thing? I'll let you bring us home, Dr. Kelly. Where can people follow you or learn a little bit more? I know you do some on LinkedIn, or is everything kind of
Sure.
behind the JP Morgan wall? How can someone listen more about what you're up to?
Yeah, so a little advertising here. I have my own podcast called Notes in the Week Ahead, which we try and put out every Monday morning. We also have other podcasts, one called Insights Now and one called Alternative Realities, which we just launched to try to delve into the world of alternatives. We do publish something on LinkedIn every week, or you can just go to the JP Morgan Asset Management website, and we have our guide to the markets, which we actually update with data every day at 10 a.m. So you get sort of the refreshed version of that. So there are lots of ways of getting hold of our information. But I really appreciate you having me on your podcast.
Awesome. Well, thank you very much. Everyone, Sonu and I are going to take next week off for Labor Day. Then we'll be back with episode 100 live from Excel in Orlando with Tom Lee. We're also going to live stream that. So just follow us on our social channels. We'll tell you more how to do that. But again, finally, thank you, Dr. Kelly. And I'm sorry I got to say it, but hopefully my Bengals beat your Patriots week 1. That's, we'll see. We'll see. But
We'll
it's
see
all
how
right.
that goes.
You had a good run for 20 years. So, it's how it goes. All right. Thank you again. Take care, everybody. Thank you. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.